You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
No discussions in the podcast are meant as an offer to sell or a solicitation for an offer to buy any security. All investments should be done after careful review and consideration of the investment documents and disclosures. Contents discussed in the podcast are not meant to be construed as an investment, tax, or legal advice. Individuals should always consult his or her own professional advisors before any investment decision.
Everybody, welcome to the Alternative Investor Mastermind. Really excited today to have somebody on that I've known and has been a mentor of mine for pushing closer to 20 years at this point. The great Eddie Speed. Eddie, thanks for joining us.
How are you?
I'm doing wonderful. It's always great to catch up. I mean, I think I first saw you as a student, and we've been in masterminds together. We've bought and sold loans to each other over the years. I feel like I know you pretty well, and I'm excited to, I'm sure a good amount of my audience does as well. But for those that don't, I'm really excited to introduce you. So if you don't mind, for those that don't know you, kind of give a little bit of your background and your story, and then we'll dive into the note business.
Well, I started in the note space a long time ago, 1980. So it's been a day or two, right, since I got started. Started out really in the seller finance space. I've always kind of remained in that space. Bought non-performing loans, scratch and dent loans, all kind of things as they cycle through the market, right? We're waiting on the non-performing right now that probably, I'm sure we'll talk about that a little bit. But yeah, I've been really a note guy my whole career. It's kind of backed me into being kind of in real estate. But my primary business has been being a note buyer.
That's great. And you've been through many cycles. I think I first was familiar with you. I was kind of the junior guy in one of the We Buy Ugly Houses franchises in the mid 2000s. And I know even back then you were, I think, buying some of the loans from that group. And then we obviously crossed paths again post 2008. Multiple cycles have, you've been through more cycles than me, but we've been through multiple cycles. Where do you see us, in today's market, sort of post-COVID, I guess you had 2008, then you had COVID, and then you had the run-up in prices. And where do you see us now?
Jack, I guess everybody that has a training business or some kind of a promotional business always says it's the best time. It's unbelievable, right? I guess that's the thing that you always hear. But the truth of the matter is, I think this is the best runway in front of us we've ever had. In the seller finance space, you basically got 18 million rent houses that people aren't making money on. You could convert a rent house to seller financing and go from about a 4% return a year, 4 cap, right, to a 10 or 11, just changing it from a rent house to seller financing the same house. So that's very good for the market. And we have been really working hard to prepare ourselves for that journey. Never seen the rent house market so tough as far as they just aren't cash flowing. And it's because of inflation. It's because the expenses went up way more than the rents went up. The NPL space is going to hit. It's going to happen. All these people running around on the internet right now talking about it like it's already happened is kind of like not from where the big boys hang out. The guys that you and I are connected with, Jack, it just hadn't traded yet. It's going to. There's 800,000 loans that are not posted for foreclosure, that are 750 days delinquent, not posted for foreclosure. And it's just sort of pent up inventory. So the NPL thing is going to happen, non-performing loans. And so that'll be a play. I feel like the seller finance thing, we just experience, right? We just saw the situation. I'm in a whole bunch of masterminds. It's full of landlords, and they all start complaining about the same thing. So we take a whip in managing these things. They're not going up right now, and they're not cash flowing. And so I said, you could model it and do something different. And everybody, you can just imagine, Jack, people that don't think like a note guy like you and I, they're like, what? What do you mean? And then you lay it out, and they're like, that was a lot simpler than I thought. I'm like, yeah.
Yeah, and it's one of the only alternatives. I have a lot of potential investors because in addition to the note space, I've obviously played in the syndication space myself as well. And get calls all the time from, what I call a tired landlord. A lot of times, like you mentioned, expenses went up. Even just personally, many are just burnt out. Some of, if you've owned it a long time, you don't have enough depreciation. So you're paying tax on the rents, and a lot of the guys and girls don't want to do the work anymore. And it's often too small to do a 1031 or too complicated because sometimes people have put them into multiple LLCs where you just don't really have enough money in any one house to do a 1031. So, what you're describing seems like, the ideal solution for a good segment of people I speak to every day. Let's dive into the math. Oh, go ahead.
Well, a lot of people, Jack, they don't think there's any tax advantages with notes. They think everything's a rental because everybody talks about tax advantages with rentals. But if you sell a long-term rental, you can take your gain over time. You can pay back your long form depreciation recapture over time. You can stretch out when you owe the IRS the money. I have a family member. I was telling my wife we're on a trip right now. In fact, ironically, I'm filming this today, and my father-in-law, who sadly has been dead now for 28 years, and we ran over running their businesses. And but this is the home turf that I started in the business way back when, 1980. I was telling my wife on the way over here, we're talking about a family member. They've got a property, they've done really well, and they've gained money with it. And the accountant says, "Oh, well, you have to do a 1031." I said, "You don't have to do one." And they said, "Well, he sounded like it was almost a must." And I said, because he doesn't know anything else. I mean, I'm sorry. I'm not saying he's not a CPA and doesn't know the laws. That doesn't mean he knows creativity, right? And I said, the problem is if you sell this house, you're going to buy a property that you otherwise wouldn't have bought because you don't like the math right now. The only reason you like the math right now is you think you're not going to pay taxes today. I said, pay the taxes and move on. If a note pays you $2,500 a month, a rental pays you $900 a month, net income to net income, same money. That's really the math.
Yes. Plus, as you mentioned on the taxes, let's say the house is worth $250,000. If you sell that house all at once and you have recapture, it's 200 something thousand in income, and you're at a certain tax bracket. If you're on the way to retirement and you're living primarily off the rental income, now you're showing 30 grand, 40 grand a year, and you're in a totally different bracket than 250 if you plan and do it correctly and you structure them correctly over time. Is that right?
You can carry a note and take the recapture over the life of the loan, take the capital gains over the life of the loan. But here's the thing about it, Jack, you and I have been in masterminds, and I would say I'm in 3 masterminds. I would say safely the top 1,000 house buyers, most of them are in one of those 3 masterminds. And I'm on stage on a regular basis as the note guy. So I'm on stage having conversations with people about creating notes, owner financing, what the paper world looks like versus the real estate, hard asset world of real estate. And here's the reality. People's income has been choked back so much today, they're like having to readjust their trajectory of where they thought they would be and when they thought they would be there. There's a whole bunch of small-time landlords that worked a lot of weekends over their life trying to manage rental portfolios so that they could retire and have rentals, and all of a sudden now their income's been whacked. Nobody did anything wrong. You know, the truth of the matter is, Jack, inflation just knocked the heck out of a lot of things. And one of them, no different than a lot of other things in life, cost you more to go to the grocery store. Everything costs more, right? And it's just expenses shot way up, and they went up way more higher and higher. Some of the fractional CFOs, Jack, that you and I know that are in these masterminds, they're the guys that do chief financial officer on a fractional basis for hundreds of these guys that are landlords. The best numbers guys that I know in the business. And I'm calling them saying, what happened? And they're basically saying, you know, when rents went up, then they went back down, and they've settled in about 20% more since the virus than they were before, right? However, expenses went up 50% and have never gone back down. And we don't think they're going to go back down. And so even in a lower rate environment, it's not going to solve the cash flow problem of rentals. I think that's just where people are.
Yeah. And then on the other side of it, you have so many people that locked in those 3% loans that there's really just not enough inventory for that first-time home buyer, or even just really a middle-class home buyer in general. I mean, housing is so, there's just such a shortage of affordable housing in most markets as far as I've seen.
Yeah, I mean, listen, the average interest rate over the past 50 years is 7.7% interest, right? If all we can do is sit around there and cross our fingers waiting on 3% interest again, it happens once every 20 years, right? And it's just, it's if that's what we think we need to fuel the economy, as far as real estate is concerned, I'm saying we've got to find something else. And of course, can like one more person make a post about a 50-year mortgage? Like, please, just one more person. You know what I'm talking about, right?
Yeah. But it's actually, if you are seller financing, you can charge a slight premium to the interest rate for the convenience of seller financing as well. And so I'd say, assuming rates are probably still going to go down a little bit, to me, it seems like a great time for seller financing as well.
Well, I think underwriting is as big a problem as rates. And you've seen me talk about this a lot over the years, this mortgage credit availability index, right? The day before the virus started, it was about at 185. Today it's at 100. That says who can qualify for a mortgage. So it's not just rates. Mortgage banking is in pretty significant turmoil. We're not saying that in any kind of a wrong sense of hate it, but mortgage banking is in a turmoil. You know that loan production is down in the residential side of lending 90%? From 2021 to today, 90% down. Is that wild?
That is wild. That was not nearly aware of that.
That's according to the New York Federal Reserve. 2021, there was 4.4 trillion in loans originated. This year, through Q3, they're 400 billion. Okay, we'll figure they do another piece of it to the end of the year, right? But they're off 90%.
Yeah, I mean, ultimately, and I live this now too. As a self-employed person, it wasn't even easy to get a mortgage on my primary residence. After years of being a number of years where I was W-2 and it was a piece of cake, all of a sudden, once you're self-employed, if you don't check all those boxes, it's very difficult to get a conforming loan. I even ran into an issue because I'm in syndications and I show a bunch of losses. They won't add back your losses if you don't own, I think, 50% of a deal. So I had deals that they're like, yeah, we see your gross, but I wanted my net to be as close to zero as possible because I don't want to pay more taxes than I have to, but that disqualifies some people. And you take AI and just, the gig economy, and a much higher percentage of the country is self-employed or in a gig economy now than I think ever.
Yeah, there's no doubt. It is a changing market. And we've built a real kind of a machine out of helping landlords convert to seller financing. It doesn't have to be a landlord. It could be something else, but primarily we've been focused on landlords. And what we're really doing is we're just helping them create mortgage banker product or the same things that would look like mortgage banker product to seller financing, right? Which I've had a long history with. You mentioned HomeVestors. I set up the note system for HomeVestors with Ken D'Angelo in 1990. So I had a long history of, working with them, helping them create notes and all that type of stuff. So yeah, I mean, we're kind of back in the vein now, and this is a venture that I'm working on, Jack. So it's a little bit future speak, right? I want to be clear about this. It's a little future speak, but I'm working with a technology firm right now that is super duper by anybody's standard. And they've been working on blockchain and all of the things it takes to be able to put loans on blockchain for years. And they've got significant dollars invested. And we are working with a joint venture right now. We think we can have seller finance notes on blockchain within 6 months. Now,
that would be incredible.
It's not 100% done yet. There's things about the model or the process, so it's not a guarantee. I want to be clear. But if we can put seller finance loans on blockchain, it's kind of game over. I think that we'll see 10 times the amount of seller financing we saw before.
Yeah, because it was always one of those markets where, you and I, we bought and sold loans, but it was sending spreadsheets back and forth, and really just sort of a little bit of a country club deals, old boys club deals, were kind of how you had to have a network of brokers to figure out who was the buyers, who was the sellers. Yeah, I would add a lot of liquidity to the market and just make it a lot easier to transact. And
you would seller finance a lot more properties if you could just keep 20% of the cash flow and sell 80%. And the people you sell 80% to, they could buy it on Monday and resell it on Friday if they wanted to. In other words, it changes everything about as you said, the liquidity world of this. And so I'm trying to be on the forefront of really helping the industry. Like when I set up the note system for HomeVestors in 1990, nobody had ever done anything remotely close to that in the seller finance industry. Like that was like a lightning bolt. And really I looked at it and said, there's nothing clever about this. I'm just teaching somebody seller financing how to make it look, smell, and taste like mortgage banker paper. And then it's more tradable in the marketplace. And then we did that. And then we helped a lot of other guys do it. And now we've looked at the market and said, this, I use the expression, you're fishing in a pond, which means how much inventory do you have to work with within whatever it is you're trying to do. 18 million rental houses is an ocean. That's the biggest level of inventory that seller financing fixes a gigantic problem that we've ever had by far. So that's why I said I think it can be bigger than it's ever been. Normally what's triggered the note space is a real estate crash. I mean, if you look back, and I started in 1980, that was a real estate crash. I lived through the 86 and then the, SNL debacle of the Southwest. And, after the 9/11 attack, and then, of course, the monster of them all was 08. But normally it's after that the notes become kind of a robust thing. But it also does really well when it fills a big gap that conventional lending doesn't fill.
Absolutely.
And that's where I think we are. Now, the whole thing of when all these million non-performing notes come on the marketplace, it's going to happen. But, Jack, it's crazy. There's 800,000 mortgages that are more than 90 days delinquent. The average days delinquent is 750 days, and they haven't posted them for foreclosure. Like, what are they doing? I don't know.
Kicking the can down the road again. I mean, and there's been cans kicked down the road since 08, 09. I mean, I definitely, there's New York paper that's, 12 years into a foreclosure fight. I think I saw an article on a post. Somebody delayed their foreclosure for almost 20 years. And those are obviously the corner cases. That's the absurdities of it. You mentioned the institutionalizing of it a couple times. Let's just talk about how people don't get themselves in trouble and why they should go to a group like you rather than just doing it yourself. So I'd imagine in the 90s and the 80s, you just sign a couple pieces of paper, a deal could have been done in the back of a pickup truck maybe. But, there's a lot's changed over the years with regulations, and I know it varies state by state. Yeah, big picture, I'd love for you to just kind of talk through, I know you can't go all the way into the weeds, but really just the basics and maybe how to stay out of trouble.
Well, a lot of people, Jack, the first thing that they want to do is they're listening to their local real estate buddies and they're saying, how do you seller finance? Well, the local real estate buddy, if he's never sold loans in the secondary market, he can't accurately answer the question, right? And what happens to people is people show up at my doorstep all the time and they've got a loan, they've been collecting it for years, and now all of a sudden they've got some triggering event and they need to sell loans. And they've written it on a land contract, or they've done this, or they've done it. They don't know. A land contract's not illegal. It's not like it's an illegal transaction. But the institutional money, as you know, Jack, can't touch that. And so you've limited your scope and the cost, the discount you'll have to take on the paper because you papered it. Yet most real estate investors think do it right in the land contract is better. And I'm like, it's not. You've made it homemade. What I'm trying to do is get people to do seller financing that is homogenous. When I say Fannie Mae to you, Jack, you instantly know that is a homogenous underwriting process. That is a homogenous documentation. It is a standard that anybody in the world that knows mortgage banking, or a realtor or an appraiser or anybody, like when you say Fannie Mae, it is a standard that the industry looks to and says, I know what that looks like. When you say seller financing, a lot of times you're saying Wild West, right? What I'm trying to do is make seller financing a standard, and it can be. And so once again, like the little operators or the Mavericks and stuff, I'm not going to fix the whole world, right? But I can go take people that are a little more scaled in the business or want to be scaled in the business, and I can help them with that, including creating an immediate liquidation system where they could go sell, for an example, Jack, part of the monthly payment. You could sell 70% of your cash flow every month and keep 30%. That sounds like a Wall Street deal, right? So yeah, that's what I'm doing. I'm bringing Wall Street ideas to seller financing.
Yeah, that's great. And that's a fit. It's a fit for both the tired landlord, as well as you mentioned, some of these groups we're in where people are wholesaling, rehabbing 50, 100 houses a month. And it may open up other acquisitions if you know it's another exit strategy, because not every house can fit the model. Sometimes it's not worth putting enough money into it to flip it retail. And the country is short of workforce housing.
The house flipping thing is got some big, disruption in it for sure. They're going to have to figure out another way. When you could flip a house to a hedge fund for 110% of what the house was worth, you didn't have to actually be a great house buyer to go make a living. You know what I mean?
Yeah. It's and I'm still waiting to see how some of those deals pan out. I know when Blackstone could securitize at 3%, and then they kind of maybe got bailed out by COVID to some extent just because values went through the roof. I was always skeptical of that trade. I think Wall Street, at least for a while, was making money on that trade. I just don't know how sustainable it is now.
Yeah, no kidding.
That was my stock market bell for the market closing at 5.
Oh, wait, what?
Yeah. No, I have my trading and brokerage account in the background, and I get the bell when the stock market closes. So where were we then? Yeah. So Wall Street's, I think they might have got away with that one, although maybe they're just smarter than me. They're usually right more often than they're wrong, but when they were wrong in 08, they were really wrong.
Jack, being around the industry for a long time, house flipping really wasn't much of a thing until, kind of like 2015. I mean, I'm not saying nobody did it or never flipped a house, but like wholesaling and that becoming the most common thing that real estate investors do is that there's no other cycle that really happened in.
Yeah.
And the reason is because you're selling to an investor, not a consumer. Normally when you sell to an investor, it's a deeper discount, right? You're selling an investor for cash. They can close quick. They know what they're doing, but they don't pay as good. Then all of a sudden, investors started paying more than consumers were paying, right? Now all of a sudden, the investors are backed way up and they're not paying way up. And so now all of a sudden, the people that were wholesaling houses, flipping in their contract, that deal's gotten not so lucrative.
Yeah, that's interesting. I haven't really been following the recent year or so on where the big boys were pricing, but it didn't seem sustainable for sure.
Right. No, it's an interesting market, and you and I've been on all these sides and stuff. And of course, in the last cycle, you were super involved in buying seconds. And there's some people sitting on the sidelines now, back that are, I'm going to wait for seconds to come out again. I'm like, they're not going to be selling the seconds at 20 cents. It's a completely different market, different circumstances, different reason that the seconds were created, and they won't it that cheap.
Yeah, and not as many were even originated.
Not even close. No. The seconds were created because they were doing such poor quality loans they couldn't get mortgage insurance. That's why they were carrying seconds. It was in lieu of mortgage insurance before 2008.
Yeah, and now the more likely second created was somebody who has a 2.8% mortgage that's financially doing well, that got a really prime loan and just is still probably at a reasonable loan to value in most cases.
Yeah, I'm not. We'll see. I feel like the sub 2 thing, where people had low rate loans and wanted to kind of secretly move them. I think that's think that's not going to work out as the way some of the ways that people thought. It got too well known, and there taught a lot of rookies to do it. And there's a lot of things kind of going wrong with that. And I kind of think Fannie Mae and FHA kind of got irritated by it. And I feel like I've got a pretty high caution flag about folks doing that.
Yeah, I definitely agree. And I've seen some posts in forums about that, about just it's one thing when you're flipping 100 houses a year, you have like a sophisticated operation. But yeah, I mean, if you're putting somebody's credit at risk, if you're promising, if you're just kind of a rookie wholesaler, or the worst was when if somebody is a wholesaler and they make a rapport with the seller, and that seller's trusting them with their credit long term, and then that person just flips the contract to somebody else. Now the seller is dealing with two strangers. That's just a major liability. That's how.
It goes back to the fact they're manufacturing, the financing the wrong way. And, at the end of the day, it's like people ask me, like, what is the number one variable you look at on a note? Like, I've been asked this, like, God knows 10,000 times, right? And I'm like, it's pretty simple. Do I believe they will continue to pay on time as they're paying now? That's as simple as it gets. There's a lot of things that lead me to believe that or lead me not to believe that. But the answer is, what makes me pull the trigger and buy a deal? I think they're going to pay. They're going to pay promptly in the future. It's going to be a win-win deal. The borrower's going to win, and I'm going to win.
Absolutely. So you've been through so many cycles, and I know nobody has a crystal ball, but like, what's your take on just what's happening in the country, just with the overall economy and AI and how it's affecting it, and like, just how does that affect like where you make your own investment decisions?
Well, it's ironic. It's not that I'm unwilling to change. I just kind of have a high expertise in the seller finance world, and I found a big opportunity with it, and I found some partners in the technology space and other things like that, AI, that we can bring ourselves to. About 80% of our due diligence is done today outsourced through. Really, they've trained AI to do it, but they've been training AI to do this for years. It didn't I know it just became really fashionable and everybody knows it, but they've been spreading mega billions of dollars worth of underwriting in the mortgage space. So I'm getting benefits of the efficiency of that as well. It doesn't mean that it doesn't ever need a human eye or a human brain, but we can certainly, a lot of things, if you can teach AI rules really well, and underwriting and document review, and those things are very rule driven, right? So it works well that it can do that. I think we're going to generally see a flat market. I don't think we're going to see anything. I don't want to spook anybody, but we don't have anything near that we have had like 2008. But the residential market's got a lot of threats right now. We got a bunch of non-performing loans that haven't come to the market. Shadow inventory, you and I would call it. We've got production and MLS sales are continuing to go down. The builder situation is horrific. Builders have the same level of inventory they had in 2009, finished homes. So when you look at that, the residential market has some dings in it. It doesn't have a gigantic backlog of problematic loans. 1 million loans is workable. 12 million loans in 2008, that was a horse of a different color. Now, don't think that 1 million loans getting pushed out there is not somewhat of a problem, because I think it is. The commercial thing, I mean, you and I have talked about this. I mean, to me, looking at the apartment situation, it was easy for me to look at it 3 years ago, 2.5 years ago, and I was not emotionally attached, and I could just see the situation. I could see the problem, right? And they were overpriced if everything were perfect. And then all of a sudden, everything became very imperfect. And so, I think I think the multifamily space has some slide left in it. And I think and is that another 10%? Is it another 20%? I think nobody's really sure. It's certainly not gotten better this year. And so I think a lot of people are looking at that, trying to figure it out. So, a lot of new commercial retail is actually doing pretty good. Retail did not crash the way people thought it was. People just like getting out, Jack. They want to go shopping on the weekend. Like, that's like, people thought everybody's going to buy everything on Amazon. And I'm just saying it doesn't meet people's cultural, social needs. And so I think that area, I know several people doing really well in that space. I think the office thing's kind of flattening out. Some of it's, still got, some of it's just really tough. Like, New York City, right? There's some stuff up there that I don't know what they're going to do with it, right? But it's, I think overall that, Jack, you and I, for the most part, have made more money in real estate by far in bad times than we ever did in great times. And so I look at it and say, we just got to pull out the old rule book and just keep looking at the things that are patterns that we can see. And I tell people that it's very simple. If you're an entrepreneur, you find a void in the market and figure out how to solve that void, how to fix that problem for somebody else. You want to know how to make a lot of money? That's it.
Very, very well said. Where I get myself a little paranoid now is, I just think about the actual job market, and I just know how many things I used to pay people tens of thousands of dollars to do that I'm doing with a $20 a month ChatGPT or a couple other tools right now. You mentioned that underwriting. I'd imagine I can envision it. I can see it, that the amount of person hours it would have taken to review 50 pages of pay stubs and tax returns. It's all, I mean, I've uploaded my tax return to ChatGPT and asked it questions, and it gave me pretty good answers. In the 90s, all the jobs went overseas for manufacturing. This time it's hitting the information workers.
One catch about AI, I mean, don't email me thinking I'm an AI ninja. I know some. I'm pretty close to some, but it isn't me personally, right? But one thing about it is if it's open AI, you have to know, like I know people that go into open AI and ask it all this stuff, and I look at the answer and I'm like, that's wrong. And they're like, well, why is AI wrong? And I'm saying, because somebody taught it wrong, right? I mean, if you're dealing with a company that's developed AI and they've taught it really, really well, then it's crazy what it can do. This company that does stuff for us, they've got AI that can read 200,000 documents an hour. It's crazy.
Yeah, that's wild. That's a very, very good point. And, and a lot of times I'll use specialized tools where they're using one or plugging into a couple of them, or even plugging into both of them at the same time. But yeah, it's a really good for a non-AI. That's one of the sharpest things I've heard.
If you are a paralegal, if you're an accountant, you probably should feel threatened.
Yeah, it's just interesting when you underwrite. Yeah, when you're underwriting somebody, it's like you can't. I guess you can't really. Well, I guess you could decide whether to buy or sell a loan, but it's funny now as you're extending credit. It's like you can't. I'd imagine you can't turn somebody down because you don't like their profession. But to me, there's a little bit of risk if you look at like what someone's doing if they're in a spot that's going to get really disrupted.
Well, yeah, I mean, the key to it is are you building wagon wheels, right? You could be the greatest wagon wheel manufacturer in the world, but there's a certain era in time that just wasn't the thing that was going to grow. And so you just have to kind of look at that and see. There's going to be it's not like people don't need a lot, like every AI is going to take everybody's job. No, those jobs are just going to be different. It's not like there's not going to be something for humans to do. Humans built AI.
Yeah, I did see a recent article that IBM had laid off about 8,000 people because of AI, but they've actually hired back 8,000 different people. A lot of engineers, so it's different roles. Yeah, that's my hope. But I do feel this may be as disruptive as any other time in history, or maybe more. But I'd imagine, people need something to do. So maybe it'll be a 30-hour work week instead of, back in the 20s, it was a 90-hour work week, or, fighting for 1 day off.
Great point. I'm more optimistic about the market right now than I have been in a really, really long time. But once again, I'm a little bit of a contrarian. So I feel like I know how to make money when other people are not figuring out how to make money. And so I'm confident that we're going to find this market disruption in a good way for us.
Yeah, I think so too. And I said that was always found a way to find the right niche in a downturn. That's when the real opportunity is. So yeah, we've talked a lot about tired landlords and high volume house flippers. So, and I know that's a big part of probably who's listening right now. Take some time, talk a little bit about I guess both Note School and Colonial, and what if someone is resonating with what they're hearing right now and they think they've got either loans to sell or houses to turn into, how do they go about it?
So what I'm going to do is I'm going to give you guys what I would call an opportunity class. So today we've sort of talked higher level, not super deep. The next one will be kind of an hour and 15 minutes of like really whiteboarding out the math, proving what I'm saying is actually true. And I think that's a good way to start, no matter whether you're on the real estate investor side or you just you're some guy that would have bought a landlord until all of a sudden you're not making money, or maybe you said your wife said she was going to kill you if you bought another one, right? That. So in other words, there's everything from the investor that wants to be an investor and wants something that is real estate secured and has cash flow, but they're not looking for a headache, all the way to the active real estate investor that says, hey, I want to go figure out a way to make more money out of the property that I have control of, right? So it's pretty simple. It's going to be noteschool.com/8, and that's really what it's going to be.
Great. We'll make sure we put that in the show notes. I can attest personally, I've been to, a number of your events over the years. It's always a ton of content, ton of value, ton of other great people as well. At least when I've been at the in-person events, nothing substitutes being able to sit down next to a bunch of people that are in the same situation you were or were in a few years ago and have gotten further along. It's great value, and I appreciate that. And any thoughts? Or?
Yeah, I think just if your audience is out there, just look for market conditions that justify the story you're looking for. Right. I read so many times people are like, they're running with a story. And I'm like, yeah, but the market doesn't line up the way your story doesn't go in the right direction to where the market's going. So you got to make sure that you're matching up the market and in the direction you're going and why you're going towards the market that's going to be kind to you.
Awesome. Well, Eddie.
Ask hard questions, right, Jack?
Yeah. Absolutely. Well, it's always great to catch up. I hope to catch you in Dallas in person at some point. I'm usually in and out a couple times a year, or I'll catch you at another mastermind. So Thanks again.
Great to see you. Thank you.
You as well. You as well.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at AlternativeInvestorMastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.